Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. My guest today is Arnold Kling, blogger at EconLog and recent contributor to EconTalk in a podcast on Fannie Mae and Freddie Mac. And I wanted to continue that conversation. We're taping today on October 24th, 2008, and this will air in the next week or two, roughly. Sometimes events have taken over these podcasts. We'll see what happens. But we're still in the midst of lots of turmoil in financial markets, and I wanted to continue my education, and I hope yours, by asking Arnold both some fundamental questions about financial markets that I don't understand, as well as some bigger issues that we wanted to bat around. So, Arnold, welcome back.
Oh, thanks, Russ.
So the first question I want to ask is just a logistic, procedural, technical question. Two topics we hear a lot about in this debacle are credit default swaps and counterparty risk. My understanding is that Bear Stearns, Lehman Brothers, and other players in this market got involved in these, but I really don't know what they are. So tell us what they are or what they were and how they played a role in this.
Okay, I'll try. I think one thing I'll have to say is that I feel like an over-the-hill geek in this. So just as a computer programmer who retired in the 90s wouldn't know anything about Java, I got out of the finance industry before credit default swaps became big. So, but I'll do my best. First, let's talk about something that's simpler. Let's talk about a corn forward contract. So let's say I make Fritos, and you're a farmer, you're trying to decide whether to plant corn or soybeans this year. And I say, Russ, plant some corn, because I'll tell you what, I'll guarantee the price for your corn for delivery 3 months from now. Deliver me 100,000 bushels of corn, I'll pay $150,000, something like that. You say, okay, fine. With that commitment, I'll go with corn. And so we sign what's called a forward contract, and that means you're obligated to deliver to me those 100,000 bushels, and I'm obligated to pay you the $150,000. And so we'll settle that up in a few months. And if it's a personal contract between you and me like that, then there's what we would call counterparty risk. You may not grow the corn or deliver the corn, or maybe I'll go bankrupt in the meantime and not pay the contract. So that's our counterparty risk.
The counterparty means the other guy.
The other guy.
That's all.
Yeah.
Counterparty makes it sound so complicated.
Yeah. Just means that you might fail. Now, how could we get rid of that counterparty risk? We could trade, instead of a forward contract between the two of us, we could trade a futures contract on an organized exchange. Did you ever visit the Chicago Mercantile Exchange or the Board of Trade while you were there?
No, I've always found future markets somewhat mystifying, so help me and our listeners understand them better. Well,
just in terms of the atmosphere, I think it would be interesting for you to contrast, let's say, the New York Stock Exchange with the Chicago Mercantile Exchange. The stock exchange has a single specialist in each stock who's making an orderly market. So there's sort of one person in charge.
Who's matching buyers and sellers when you say making an orderly market?
Well, he actually often does a lot of the trades against himself. So he has his limit order book, which is a list of orders. Like there are a bunch of people say, well, I'll sell my IBM as long as the price gets above 100, and somebody else says, I'll buy IBM as long as the price gets below 99. And so he's got these orders, and then as new orders come in, let's say you're willing to sell at 99, and I know I've got somebody willing to buy at 100, and I'm the specialist. I'll buy yours at 99, and then I'll sell to the guy who's willing to pay 100. And so they mostly make these tiny little arbitrage profits, but they're supposed to make orderly markets even when when there are challenges, and so sometimes they're supposed to be willing to lose money to keep the markets going. But it's one person in charge. You go to the pits, you really should take a trip to the Board of Trade or the Mercantile Exchange, and it's chaos. There's nobody in charge of any one of the markets. It's just a bunch of...
Kind of like the economy as a whole.
Exactly.
No one in charge.
No one in
Chaos.
charge.
Yeah,
Chaos. You've got a bunch of traders shouting at each other, wearing outrageous clothing. A lot of football players, because they're big and easily noticed, a lot of former football players or floor traders, and they're shouting at each other and they're making trades at each other. And they're the ones who are making the market. So when you send an order into the Chicago Mercantile Exchange to trade, it goes into this chaotic environment where these market makers execute the order. So that's just an interesting side note. And by the way, it works much better. The reason that there are futures markets and things like stock indexes and treasury bills is that the markets in Chicago are so much more efficient than the markets in New York that most of the more advanced trading takes place in Chicago, and then New York kind of follows behind. So it's an interesting illustration of the spontaneous order versus the managed order.
So let's go back to our corn.
But so our corn's going to be sold in Chicago when these crazy mercantile exchange.
How's that going to work?
And how that's going to work is you're going to sell a futures contract on corn, you as the farmer, and all that means is you are going to, on closing day, pay the price of corn, whatever it is. Now, the way you're
closing day 3 months from now?
Yeah, 3 months from now. So the way it's going to work for you is you're going to, let's say the corn goes way up in price. So it's instead of being worth $150,000, it's worth $300,000. The way you're going to handle that is, well, you actually produce corn, so you'll sell the corn 3 months from now for $300,000, and then you'll pay it into the futures contract.
What does that mean?
So you'll let's say you sold the futures contract.
Hang on. Now, this is what I'm literally going to do. This story is going to explain how I'm going to avoid my anxiety that you as Fritos may be out of business when I've gone to the trouble of growing all this corn.
Right, because you're dealing with the exchange. So let's say you've sold the futures contract for $150,000. You say, $150,000, that's more than the cost of that'll.
I'll be comfortable with that.
Yeah,
that's a good risk for me.
That's good for me. I can produce corn profitably for $150,000. So you sold that, you locked that in, you're happy.
When you say I've sold that, I've tell me again very mechanically.
You've sold a contract. You've basically made a commitment to the exchange that you will deliver cash equivalent to what that corn would be worth 3 months from now. It's called cash settlement. So you're not actually delivering corn. You're delivering cash based on the change in the price of corn, of the price of that contract, the way it is today and 3 months from now. So if the contract goes up by $150,000 to $300,000, you have to deliver $150,000, which is the difference.
An extra $150,000.
You have to deliver the $150,000 difference.
Okay.
So you do that, but you don't mind because you've got an extra $150,000 profit on your corn. You're selling it for $300,000 instead of $150,000. So You're cool with that.
Who gets my money?
The exchange gets your money. The exchange then turns around and pays off somebody who won a bet. Let's say Fritos was worried that the price of corn was going to go up, and so Fritos locked in their $150,000 price for corn 3 months from now. The price went up to $300,000, but Fritos is going to have to go out and buy corn for $300,000. You think they're in trouble, but in fact they're going to gain $150,000 on their futures contract, so the corn only costs them $150,000. So the exchange gives them the $150,000. So when you have,
I gave up the opportunity as the farmer, I gave up the opportunity to profit, but I wasn't at least worried that I wasn't going to get anything or that the price might go down.
Right.
Fritos gave up the possibility the price of corn might go down, but they locked in their price of $150.
Right.
So we both were able to lock in the price by selling this promise to somebody else.
Yeah. Well, so instead of a specific counterparty both of us, both Fritos and the farmer, their counterparty is the exchange. So if you as a farmer for some reason default on your futures contract, the exchange is going to have to take the loss. So the exchange has to manage all this counterparty risk. And that's why an organized exchange is said to eliminate counterparty risk.
And they're going to, of course, take a premium from each of us for the insurance we're effectively buying, and that insures them against the possibility that some proportion of the large volume of trades doesn't pan out.
Right, and they're going to impose margin requirements on you, and suitability requirements, and capital requirements, because they don't want to be dealing with defaults. They just want to settle up at the end, and so that's an exchange, and that's how an exchange supposedly eliminates counterparty risk. And a lot of what we're hearing about credit default swaps, and I'll explain what credit default swaps are in a minute as best I can, is that we would be better off if they had been traded on an exchange. And in fact, there was a breathless Washington Post expose about a week and a half ago of the battles between different regulators. It was actually a turf war, but it was battles between different regulators over whether to require credit default swaps and other derivatives to be traded on exchanges.
How could you require something to be traded?
Traded on an exchange?
I mean,
that's a good question.
Wouldn't it normally, if it were a good idea, people would like the idea of it and it would emerge, and the government might want to regulate it in certain ways as they do the other exchanges, but how could you force people to trade it? Do you know?
That's a good question. I guess you might somehow make it illegal to trade these
privately. Yeah.
Privately.
Okay. Sorry. So go ahead.
Yeah. But in any case, yeah. There are a lot of people who believed then, and even more who believe now, that the real problem with CDS, credit default swaps, was counterparty risk, and if you put them on an exchange, you'd get rid of the counterparty risk, and life would have been much better. I'm going to argue against that, but first let me explain what a credit default swap is, as best I understand it. So let's say you own a General Motors bond that's going to pay you, 5-6% or whatever, and you're a little nervous that General Motors may actually some point default. So
this is a 5 or 6% bond that's going to mature 20 years from now, and in the meanwhile, the Chevy Volt might not make it. There could become a solar-powered car that puts them out of business. They could just get beaten by the Japanese, et cetera.
They make bad
American
decisions. Anything
competitors,
can happen. Right. Anything could happen, and you won't get your principal back, and you won't get your interest. And so somebody offers you basically an insurance policy against that. That if that bond defaults. Now, the contract could be written in terms of that particular bond that you own, or it could be written as a generic if General Motors,
defaults,
goes bankrupt or something.
I have to interrupt. The bond is already a somewhat less risky hedged thing because the stock is riskier than the bond. The bondholders are in the line. In the case of a bankruptcy, there'd be some assets, for sure, and bondholders would be first in line. Right.
That's nice, but you have to realize that there are a lot of institutions that own bonds that have a need to have those bonds rated in a certain way, like AAA, AA, what have you. And so in some sense, the risk that you're worried about isn't just that it could default, but that it could slip from AAA to A, and then all of a sudden you're violating some agreement with the people who invested money in you. So if you're an institution and you've got these bonds and you're supposed to be having AAA bonds and all of a sudden they get downrated.
Not because Jim goes out of business, just because it might be more likely.
The risk goes up. Again, a credit default swap would sort of guarantee to you that, okay, this can't possibly be below AAA because I've got this credit default swap.
So how would it work?
So the way it would work is if this event, so you pay a fee. Let's say you're the institution holding the bond, and let's say I sell you the credit default swap. So you pay me a fee, just like an insurance premium. And in return for that fee, I make a promise to you that if this bond ever defaults, I'll make good any of your losses.
Which preserves the AAA-ness of
It
the bond.
more than preserves the AAA-ness, yeah. It absolutely makes you have a nice guaranteed asset, yeah.
But it, of course, raises the next question, which is how do I know you'll be there to pay off?
Okay, and that would be the counterparty risk in the credit default swap market. And so now you can see where maybe if you had an exchange, these things would work. Now maybe I can get into my argument about why I don't think an exchange will work. And that's because.
But let me just make sure. Let me get the institutional component straight. I'm a pension fund, or what else might I be?
Insurance company.
An insurance company, and I'm holding GM bonds as part of my investment portfolio, which is, in theory, one of the safer parts because I have equities as well, I have other kinds of bonds. I'm worried. I've got some legal requirements about the riskiness of my portfolio, and I'm worried that their GM could slip. So what do? I go to you, and are you AIG, for example?
Yeah, I could be a big insurance company. Or conceivably.
Who else was offering these
I'm
credit
not
default?
I don't really know.
Okay.
To be honest, I suspect that even some investment banks were doing it, but there is this question of who could offer these. But
okay, so put that aside. But let's say you're an insurance company. I'm worried about this. I go to you. We make a contract that says if GM goes bankrupt or if GM doesn't pay off my bond, which are two slightly different things, then you're going to make them good, 100% too. It's not just I don't get just some of it back. I'm going to get the whole thing back. So now supposedly I sleep well at night because I've covered my risk there. And the only risk I have now is that AIG or whoever this is would go bankrupt. And of course, there's regulation of AIG. It's got to have certain credit requirements, and I assume that's...
Yeah, and it'll have a very strong credit rating itself. People talk about renting their credit ratings. So a very highly credit-rated firm can make use of that fact.
Earns a premium in this
business.
Earn a premium. Yeah. Okay, so... one argument would be, though, that since there's still risk, because AIG could go bankrupt, which of course they did, and then in case the government didn't bail them out, then I would be, as the holder of that credit default swap, is that the the language? Maybe it would have been better if we'd been able to trade these on a futures market against GM's failure to pay off its bonds. But you think that's wrong?
Yeah.
Or not so good?
Yeah, I think that there's something fundamentally untenable about a credit default swap. And that is that in the corn example, there was a natural long and a natural short. There was somebody, Fritos was in a natural position to want to buy the futures contract. The farmer was in a natural position to want to sell the futures contract. In the credit default swaps, I don't think there's a natural seller. That is, you can understand why there's a natural buyer. The pension fund is afraid of risk. But who is a natural seller? Nobody really. It's, so when I posed that question on my blog, somebody said, well, insurance companies can sell stuff. We have insurance in property and casualty insurance. We have life insurance. But insurance is a very different thing than a market of natural longs and natural shorts hedging each other. Insurance requires lots of capital, it requires lots of reserves, and it requires very uncorrelated risks. So for credit default swaps, AIG might have had a lot of capital, and maybe they had enough reserves, but there's this issue of uncorrelated risks. If you're a property casualty insurance company and you've got insurance all around the country and there's a hurricane in Galveston, well, maybe you survive. But if there's a sort of universal event that can hit the whole United States, you're not going to survive. And with credit default swaps, there was, I think, the potential for lots of firms to turn bad at once. And in fact, that's what happened. So that makes it, I don't see how the exchange can solve that problem. I mean, so if you're offering, a futures market has an exchange with lots of small traders, and even though that each of them is small, they have a very small probability that anyone of them will default. With a credit default swap, I don't think you have the same thing. The exchange cannot manage its risk just with a bunch of small people offering these credit default swaps.
Well, let's put that to the side. It's an interesting side note, but I think what does all this have to do with the mess we're in? What role did credit default swaps play in Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac?
Again, I don't know enough institutionally to know exactly the role. The accusations that I'm seeing are, first of all, that they made it appear less risky, made things appear less risky than they did. So the sellers of credit default swaps. So let's say I buy a mortgage-backed security. I think I may be able to get a credit default swap against that security. And so that may enable me to think that I've got less risk. The other thing is that a lot of these companies that went bad, I think went bad either because they had sold credit default swaps, I think AIG being the most notable example, or because there were credit default swaps involving those companies. And this is where why I think it's sort of an untenable situation. How can you sell a credit default swap? Well, maybe you could have lots of capital and lots of reserves, and that's how you do it. But I think the way they were really sold, the way the sellers really thought that they would meet their obligations having sold credit default swaps, is that if they saw things start to go bad, so let's say I've sold you this default swap on the General Motors bond, and I see and some bad news comes out about GM. And so I think, I might have to make good on this swap. One way I can protect myself is to go out very quickly and short GM bonds or stock. And so if things get worse at GM, I'll make money on the short, and then that will offset some of my costs of making good on the default swap. So everyone who's sold these credit default swaps, I think, has this contingency plan in their minds that they're going to go out and short the bonds and stocks of companies that start to get into trouble. Now you can see where individually that might make sense, but collectively the effect of that is to put huge downward pressure on firms the minute they get into a little bit of trouble. So that's what's called systemic risk.
Right, but how would that work in the mortgage market? If I'm Bear Stearns, I'm holding this mortgage-backed security that all of a sudden in 2006, in 2005, it was just seemed like the sweetest deal of all time. Housing prices are going up. All of a sudden in 2006, it starts to dip back down, and the default rate and foreclosure rate jumps up, and I realize, oh my goodness, that's not going to be as attractive as it turned out to be. Okay,
well, imagine that, go back to where the days of yore when Freddie Mac and Fannie Mae did not have an explicit government guarantee, but only a line of credit, and then whatever too big to fail implicit thing was. So, let's say June, July of this year, and you are a pension fund holding a ton of Freddie Mac securities, and you're reading in the newspaper that they're taking some big losses. And you say, I think I'd like a credit default swap against Freddie Mac just in case, because I've got so many of these securities. It'd be really embarrassing to me if they turned out that they went bankrupt and they didn't, in fact, guarantee them. So I'd like a credit default swap. I mean, it could even be against their debt. So you go out and you buy credit default swaps. The people who sell them to you turn around and sell short Freddie Mac's debt and stock. Well, after a while, Freddie Mac's stock has plummeted. It looks like they don't have much capital. The interest rate on their debt is high. It looks like it's going to cost them a lot to borrow to stay in business. And the whole thing just cascades on itself.
Do you think that's what happened?
I think that happened with a lot of companies, yes.
Well, let's go back. I want to go back to, I think it was last March, to the first domino, which was Bear Stearns. There are probably some preceding dominoes. And you and I talked about this, I know, off the air, and maybe we talked about it in an earlier podcast. but I want to revisit it because I know a little bit more now than I knew then, and you may not know more. You knew a lot then, so I don't know where you are in the knowledge curve. But at the time, it's kind of those were the talk about days of yore. They were 7 months ago. It seems like an eternity ago. We were in such a different world. I remember thinking about being asked by people whether there was a chance that X, Y, or Z would go bankrupt, and I thought, well, of course not. It's not going to happen. And if it did, it would be such a catastrophe. That would be the least thing you'd worry about. But in fact, all those dominoes fell. Or many of them. Let's go back to Bear Stearns. Bear Stearns is an investment bank that has a hedge fund operation that has been buying a lot of mortgage-backed securities, many of them subprime, having subprime loans in them. And suddenly we're going to find, and it came out of the blue for us. I mean, obviously for the people involved in Bear Stearns, they were probably starting to worry about it in advance of that famous weekend. But on a particular weekend, we come to find out that Ben Bernanke and Henry Paulson have decided that it is imperative that Bear Stearns be acquired by somebody, lest they fail. And the argument at the time was because if Bear Stearns fails, oh my gosh, Lehman Brothers could be next. So we've got to stop that from happening. And it's interesting to go back again as if it were ancient history. It's not a few months ago, but it's interesting to go back and look at the arguments that were made at the time and how they panned out. The arguments that were made at the time were there was no alternative. It had to be done. And what was done, which I thought was very strange for a constitutional democracy, was that J.P. Morgan, correct? Was it J.P. Morgan?
Bought them. Yeah.
Bought them at the time at a sweetheart deal.
Right.
There was no auction. There was claims that there weren't that many people who could buy them, but they were bought, and they were the claim was this was necessary because if Bear Stearns failed, and I think we did talk about this on the air, they'd go into bankruptcy court. They'd go bankrupt, and then the next thing you know, all these other financial transactions that Bear Stearns was acting as a sort of clearinghouse, and I have no idea what they were actually doing. They'd be all tied up. The whole system would freeze up, and we'd have a frozen credit market, which of course what we ended up with, ironically.
Maybe
it was claimed in the latest crisis. So what happened there? Do you understand what happened to Bear Stearns?
Not specifically, but let me guess this way, that Bear Stearns and other investment banks and even some large commercial banks are engaged in some very short-term trading with each other. I mean, there's something called the repo market, where I sell you a treasury bond and I agree to repurchase it in a week. And it's a way of carrying these securities for very short periods, and it's a very thick market. It's actually the market when the Fed intervenes. We say that the Fed changes the Fed funds rate. They typically intervene in the repo market. So they'll go long repo, I think, if they're trying to reduce interest rates, and short repo if they're trying to increase. I may have that wrong. But so it's a very important market, and there are a lot of things other than treasury bonds that are carried on in this repo market. It's characterized. It's very important since you're holding these securities for a week that the credit risk be essentially zero. Because if you had a 1% default risk and you had to earn enough interest in 1 week to make up for 1% default risk, I mean, you'd have to charge hundreds of percent interest to make that up. And so it's very important that this be that the default risk be low. Presumably Bear Stearns was trying to trade everything in these short-term markets, including its mortgage-backed securities and so on. So if all of a sudden people are starting to get just the slightest bit skeptical that these mortgage-backed securities are going to come through, they're going to default, then they're going to take huge measures. They're either going to charge very high interest rates, or they're going to require what's called a large haircut, which means, and given the counterparty risk that's involved in the repo market, what a haircut means that I will lend you based on $100,000. You have $100,000 worth of collateral that you want me to lend you money based on, but I'm only going to lend you based on $99,000 worth. You have to post the full $100,000 of securities as collateral, but I'm going to cut off 1% of that just in case over the next week there's a drop in value in that collateral in addition to you defaulting. Which would be the circumstances in which I'd have to take that collateral. You have to default, and just in case while you're defaulting that it falls in value, I'm going to take a haircut. So what I suspect happened with Bear Stearns is that people started demanding larger and larger haircuts, or ridiculously high interest rates on some of that collateral because they saw signs that collateral might not be worth anywhere near what Bear Stearns said it was, or you just couldn't even figure out what that collateral might be worth because it had these dodgy loans underneath it. So
here's, I'm going to stop you there.
Okay.
I'm going to stop you there because here's the next question. I'm going to try to bring us up to the present and move us away from some of these details for listeners who are maybe ready for some more philosophical content. Yesterday, in sort of what I suspect will be seen, I'm afraid, as some kind of landmark moment, Alan Greenspan flayed himself publicly, beat his breast, said mea culpa, took a few lashes and said, my whole worldview, my ideology was wrong for 40 years. The evidence seemed consistent with it, but it turns out laissez-faire is a horrible idea. I thought banks could regulate.
Of course, that isn't what he said. That's what the media said.
Well,
what he said.
Yeah, the way the media, some of the media, not all of it, but the way it was interpreted by some was that Alan Greenspan had admitted finally that markets can't regulate themselves. Now, what he did say, I think, I'll paraphrase it, but I think he did say, which I think is challenging to those of us who are market oriented. He said, market oriented, hardcore market folk like myself. I'll let you speak for yourself, Arnold. But what he did say is that, I thought banks would look out for themselves and that would be sufficient to prevent this kind of mess. And in particular, is referring to derivatives and mortgage-backed securities that cascaded through the financial market, like we're just talking about. And obviously, the biggest fan of capitalism, whether it's Milton Friedman or Adam Smith or Mises or von Hayek, nobody suggests that people don't make mistakes. People do make mistakes. Markets don't work perfectly. Sometimes people overgrasp, overreach, take on too much risk, ignore their own apparent self-interest, or make an error. And what I find interesting for me, the crucial question of these stories of Lehman and Bear Stearns, and even to some extent Fannie and Freddie, even though they're quasi-public, is that did the participants see this coming? Do you think they realized that they were on the edge of a precipice, or was it a big sandbag in the back of the head and all of a sudden the lights are out?
Yeah, well, the story that...
How could they not know?
Well, the story that you want to hear is that the evil CEOs knew exactly what they were doing, and they were looting their shareholders along the way. That they knew they were loading their companies with risk, but along the way,
they were raking it in.
As long as they could disguise the risk or postpone the risk, they could take bonuses and golden parachutes and do it fine. That's a great, compelling story. I think it's a fictional story. I think they actually thought that they were not putting on as much risk as they were. I mean, I'll give the one example. I detest the Freddie Mac CEO, Richard Siren, but I don't believe for a minute that he knew that he was radically endangering the company. I think he was warned that he was endangering the company by people underneath him, but he said, those people must be wrong. I came to this company, and company has a reputation of resisting helping the affordable segment of home buyers. They're conservative, and they're wrong, and the risks are not as big as they think they are. And so he genuinely believed that he could expand into subprime and other areas
all day, and
without
compromising
the soundness of the company. If you had told him in a convincing way that this was, if you'd shown him a movie of the future, and this is what will happen if you go into this, he would not have done it. And I think that's probably true for most of these executives. For the typical banking executive just didn't understand. That's why I keep referring to the suits versus geeks divide. I think there were some people at lower levels who saw this.
These are the geeks.
These are the geeks.
The technical
people, the modelers, and so on, who saw it. I'm sure that there had to be people. I even was talking with somebody at a congressional committee, suggesting that they could ask for documents from Freddie Mac and Fannie Mae, from their economists, about the potential that there was a home price bubble. If there were so many people, there were enough people talking about it. Dean Baker, Paul Krugman, Bob Schiller, Ed Leamer. There were lots of people talking about home prices
Larry
being
Summers.
too high.
I mean, these are not obscure corners of the...
Yeah. I'm sure that there were economists at Freddie Mac and Fannie Mae worried about it. I'll tell you, back when I was at Freddie Mac in the late 1980s, the economics people wrote a memo saying that California and Massachusetts had experienced high home prices and we should take steps to limit our exposure, and we did. I mean, that's... So, again, I think there were geeks down at that level who understood that. I think somehow the hubris at the top just overwhelmed that. And I'm not sure that you can say that government would have done it. I mean, government was aware of all these things. They were aware of credit default swaps. They were aware of house prices, and they were aware of the people worried about the bubble. But nobody tried to impose the types of regulations that would have stopped this. You could have imposed tough capital requirements throughout this, what I call the American industrial policy of housing. I mean, it is really the analog of the Japanese manufacturing export sector for the United States. It's just as Japan coddled and combined government and banks and companies and assembled them together to make a manufacturing export sector, the U.S. combined government, quasi-government, banks, and private firms to support the housing sector. This was our industrial policy, and there are plenty of things that you could have done along the way to say, whoa, this is out of control. Let's require people to make down payments. Let's require Freddie Mac and Fannie Mae to set aside enough capital to deal with what could be a big potential drop in home prices, given how fast they've risen relative to fundamentals. So all the regulatory tools were there. We don't need more regulatory tools. What you needed was, better foresight and will to use them, and that's not something you can always assume exists.
Okay, well, let's take the other approach, which is, of course, we could have stripped out the industrial policy and let homeownership be an emergent, voluntary, non-top-down, non-subsidized activity, in which case we'd have had lower homeownership rates and none of this would have happened. But the real puzzle, I think, why Greenspan was forced to grovel yesterday was that even with the quasi-public and explicit public tampering, steering of this market, it's surprising, I think, to most people, because certainly no one anticipated the full effects. There were people who said housing prices could fall. So to me, the puzzle is, if the government had let Bear Stearns fail, might that have been, what else would have toppled? We don't know, of course, but would the whole thing have fallen apart?
It depends what you mean by fail. if you mean throwing them into bankruptcy court so that all their assets and liabilities get tied up in court, then I think you immediately destroy every other Wall Street firm and every firm that has a transaction with them. So that's
a strange thing, isn't it? You find that bizarre? Think about that. Forget all this. We just had a very nice overview of systemic risk. Are you telling me that the nature of Wall Street that had evolved by March of 2008 was such that if any one of these investment banks failed, the whole financial system would collapse? Because that's a very strong claim.
Yeah. Okay. But
no one else? Did anyone worry about that?
Oh yeah, I think people did. Maybe not as much as they should have, or maybe they couldn't come up with a better solution. But no, it was not. It was not a robust system in that sense. But the thing is, bankruptcy need not have been an option, right? You could, what they did were sort of letting someone else buy the company and then buying some of the most toxic assets.
They made the sale of Bear Stearns attractive by guaranteeing $29 or so billion worth of assets that were of unknown value, supposedly.
Yeah. So
think how small that number is, by the way.
Right, compared to
$29 billion.
Yeah.
But that wasn't enough. That did not save the system.
Right. And no, the investment banks and banks managed to load up on a ton of risk. Now, one way to look at it, this is Robert Merton's calculation that the value of housing in the U.S. had reached something like $20 trillion, and then it lost let's say a quarter of its value. So that's a $5 trillion loss that's sort of spread throughout the system. Some of it's homeowners, but not very much, because homeowners didn't put very much down on their on the latest home. So a lot of that risk, that $5 trillion is spread throughout the financial system. So you can imagine that there'd be a bunch of companies that would be in pretty deep trouble as a result of it.
But what would you say is the size of the U.S. capital stock? 60 trillion?
Oh, more, yeah.
70?
Yeah.
So $5 trillion is, it's a bad year. But why is it?
Well, you're right. You can survive that. I mean, an interesting comparison is with the internet bubble, which destroyed, lots of wealth relative to the total wealth at the time. And we let the firms involved fail. A lot of venture funds yielded nothing. Companies that invested in internet stocks did very poorly, and a lot of internet companies went out of business. We recovered from that. I think that is actually a better model for how we should be handling this situation. I think the challenge with investment bank is to find an orderly way to liquidate it. I mean, the nice thing about internet stock, when it goes, it goes. There's not this cascading effect. But I think there are orderly ways to liquidate things. Certainly there are orderly ways to liquidate banks. I mean, the FDIC does it all the time. And what's missing in this crisis to me is lots and lots of banks being liquidated. Because it seems to me that if they've lost money and they're insolvent, that's what ought to be happening. The injecting capital into them, I mean, that's not what we did with the internet stocks. We didn't say, they've all failed, let's inject capital into them. We said, let them fail. And that's mysterious to me. I cannot tell you why the policy isn't to try to find orderly liquidations. I can understand why you wouldn't throw them into bankruptcy, but I don't understand why we don't go for attempt an orderly liquidation of these. Well,
presumably the answer is political. So let's move to that. Where our other topic for the rest of this conversation is a very depressing one for me, and maybe for Arnold too. I don't know. He may enjoy it a little bit. I enjoy it a little bit. And that's the state of macroeconomics in the wake of this. What I found striking about this whole crisis, and we're in the middle of it right now. It's certainly not, we're not out of the woods in many, many dimensions. But what fascinates me is how little economics has to say about it. So when the bailout was first proposed, a whole bunch of economists said it was a bad idea. I think 200 illustrious finance economists signed a letter saying, don't do it. A bunch of other illustrious economists said, it's a really good idea, do it. Now, that's not a big deal. The fact that people disagree about a particular policy, there's 100 reasons why you might disagree about it. What I found striking was how little consensus there was about what might replace it if you thought it wasn't the best idea. There were all kinds of suggestions that were made, but none of them were particularly compelling. Nobody had, I think that's why we got it, by the way. There was never a moment where there was a chance to rally around an alternative. Those of us who were skeptical about the ability of government to solve these kind of problems argued, just wait. Let's just take our time. I think you wrote, let's hold some hearings. Let's get some information. But the consensus by a lot of political actors certainly was, and many economists was, we can't wait.
Right.
It's urgent. It's got to be fixed immediately. Even a bad solution is better than no solution at all. Very akin to the Great Depression, by the way. And as a result, to me, economics at the macro level has been exposed. And I'm going to say one other thing, and I'll let you react. We talked about this a little bit before we started taping, and we've both written about this. A lot of what's going on right now is narrative building. People are trying to create a narrative. And I may have spoken about this a little bit in last week's podcast with Michael Munger. How could you test any of these narratives? The system, I mean, you and I have already now talked for almost 2 hours on the air, and we've talked for another hour or so off the air, and we've both written thousands of words, and we're just two of the people writing thousands of words. There's dozens of people writing thousands and thousands of words. None of this is testable. None of these narratives are very testable. It's such a complex system. How would you ever begin to adjudicate between the different theories that have been proposed for how we got here and what might get us out? It seems to me the only thing left is micro. The only thing left is understanding that, this policy is going to have this incentive for this group of actors, but to suggest that we can rebuild the financial system from the bottom up seems like a hopeless task.
Yeah, well, you've asked the toughest question first, and so I'm tempted to dodge it. Sort of how can we test this stuff? Something that comes to mind is 1971. You probably were an undergraduate.
Yep, I was a junior. I was a junior in college.
Okay, I'm a freshman.
No, excuse me, I was a junior in high school in 1971.
Oh, really?
Yeah.
Okay, so I'm a freshman in college in the fall of '71. And that was an exciting time. It turned out the first semester of economics class at Swarthmore College, which I was macro. So I took macro. One of our professors was on leave at the Council of Economic Advisors, and they executed a policy that was right out of the latest textbooks.
The council did.
Yeah, they put in wage price controls.
Oh, yeah.
That wasn't the council so much. The council was dragging their feet. But the Treasury Secretary, John Connolly, sort of the Henry Paulson of his day, imposed wage pricing controls, and that was right out of the textbook. The textbooks had equations that could explain what would happen if different things happened, and the textbook view was that inflation was caused by people fighting over income shares, so that you were trying to raise your wage while I was trying to raise my wage, and neither of us took into account the fact that if we both raised our wages, prices would go up, so our real wages wouldn't go up as much, and so we needed these wage price controls to stop
this cycle that was spinning out of control.
Yeah, this market failure, this externality. Yeah, we had to deal with it. Long story short, they were a disaster. It took 10 years to recover from them. But sort of we thought we knew a lot, and we were taking stuff straight out of the textbooks. What's going on now is not out of any textbook.
That's right.
And it's certainly not out of any graduate course. There's no, if I actually looked up, there's a book on the Great Depression that's an interview of sort of the modern economists. I'm blanking on the author, which is horrible, but I'll remember it.
We'll put a link up to it.
And and I read the interview with Bernanke, and Bernanke basically says at the end, all you really need to do is inflation targeting, and that is the
to avoid the depression.
That's all you need to do is inflation targeting.
And what do you mean by that?
It means print money at a rate so that inflation stays somewhere above zero, but presumably somewhere below like 4 or 5% where it starts to get out of hand. That's all you have to do. And that is the absolute consensus in macroeconomics today. I mean, I just saw this, I think, very ill-timed paper by Olivier Blanchard saying that the state of macroeconomics is good, and he's describing how we've achieved a consensus, and that consensus would tell you that there's no way you would have a Great Depression as long as you did inflation targeting. Now, all of a sudden, everybody's talking about a Great Depression if you don't bail out the banks. Where did that come from? That's not in the textbooks, and that's not in the graduate courses. So I think, I don't see any connection between macroeconomics and what's going on. You actually have some people pointing out that if you really believed some of the recent macro, that you wouldn't do anything. And that perhaps recent macro may be right. For example, there's macro that says there's real business cycles and the financial sector doesn't really affect the real economy. That would tell you you can just sit back and
it's like the shirt market. If the shirt market collapses, so the shirt market collapses.
Or the internet. Yeah, it's just like...
Just another sector.
It's just another sector. So it's just like, okay, so the internet stocks collapsed, we survived that. So a bunch of banks will go out of business, we'll survive that. It's not... There's no transmission mechanism that's been demonstrated between the financial sector and the real economy. That's one point of view, and that may be valid. I mean, so far, we have not had 20% unemployment or things like that.
It's early, though.
It's early. We'll see.
I don't think we will, but...
Yeah,
there are a lot of things I didn't think we'd see, and we're seeing them. So,
but I'm actually more nervous about Paulson and Bernanke being the disease that they purport to cure on that one. So we don't have So what we're doing has nothing to do with textbooks, and what theory we have might suggest to do nothing, that you don't have to do anything. You either have to do all you have to do is inflation target with monetary policy, or you may not have to do anything because the real and the financial sector aren't that closely linked.
Which reminds me of another issue I think I've learned about from you, which is the great man theory of politics. One view of politics is that you just need the right people in power. As I've talked about on the show before, the public choice theory tends to say it's the incentives. And what I've learned from you is this nice way of putting it, which I think is very insightful, that you really don't want to rely on picking the right person. You want a system that doesn't require picking the right person. So it's ironic because my non-economist friends come up to me and they say, boy, it's a good thing, of all the people you'd want at the head of the Fed, who could be better than Ben Bernanke? Because Bernanke was this authority on the Great Depression. And in theory, that's a great point, right? Of all the people you'd want, he is probably the guy you'd pick ex ante. He's the guy. And the similar conversation you hear is, who would, again, we're taping this on October 24th, 10 days or so before the election, who would Obama or McCain pick as their Treasury Secretary? That's the key question. Yeah. And isn't it strange? I've wondered that they haven't named who that person. Wouldn't that be wise to pick who that person would be? As if those two people, the chair of the Fed and the Treasury Secretary, could, through their great wisdom, steer us through this crisis. And it seems extremely unlikely.
Yeah, that brings up this topic of sort of the knowledge-power discrepancy. My view is that knowledge is becoming more and more dispersed. I mentioned the suits-geeks divide. The people who really understand the behavior of mortgage securities are buried so low in organizations throughout the country that no one hears their voice. And the people who have the power don't have the knowledge. Even Bernanke and Paulson really don't understand mortgage credit risk. And a few weeks ago, we heard that this $700 billion was going to go to buy mortgage securities. That whole plan somehow dissolved.
In a week.
It dissolved in a week. So,
and instead it was the first 125 billion and perhaps the second 125 has gone into capitalizing banks that were at risk of failure and were told that they had to go out and use the money.
Yeah,
it's horrifying.
It's completely made up. It completely, to me, it shows that they didn't know. I mean, if they knew 3 weeks ago that these assets were undervalued and that buying these assets was going to cure the problem, then why did they completely turn around and choose a different policy today? So, to me, that's the most kind of fascinating and indeed frightening thing going on, is that I believe that knowledge in the economy has become more and more dispersed. Going back to 1971, why were wage and price controls even plausible? Well, in World War II, we had wage and price controls, and John Kenneth Galbraith was actually part of the bureaucracy doing that, and he later was a big champion of wage and price controls. And they worked in World War II. You had a simple enough economy that you could have wage and price controls and not completely wreck the economy.
They worked in the sense that they didn't that the costs were not transparent.
Well, but the economy didn't really grind to a halt, and it didn't really. They were manageable. The bureaucrats didn't say, "This is ridiculous. We can't even do this anymore." Whereas with the Nixon wage and price controls, it reached that point where the bureaucrats said, "Hey, we don't even have the knowledge to do this. We're in over our heads. We got to get out." And so I see the trend in the economy is getting more and more complex, harder and harder for any one person to understand. Just look at any body of knowledge. Look at medicine. No doctor can keep track of everything in medicine. Nobody can keep track of all of science. Well, the world is just getting more and more complex, more and more specialized, more and more difficult for one person to know everything. So this dispersion of knowledge, and yet in this crisis we reach for concentration of power. We say, can't we just give Henry Paulson and Ben Bernanke all the power they need to solve this?
So they can fix it.
So they can fix it, so that we if we centralize power, put more power in Washington, then we'll be safer. And I think that's wrong. I think that this is, that Hayek is right, that markets are a way of solving information problems when information is dispersed, and we really ought to be looking for a Hayekian solution rather than a centralized solution for this.
But there's two aspects of the Hayekian dispersion here that I think are important to keep separate, and I think you've maybe merged them unintentionally. One is what institutional structure or policy might make things better, might be a step toward stability, might be a step toward financial markets working more effectively. The second is, and that I'm not sure if that knowledge is dispersed. That knowledge just might not be out there. And that's really the state of macro that I think is disturbing.
That's a good point. I think, nobody knows how to put together a central plan for the financial system, and yet that's what everyone's insisting that we need. We need a new financial architecture.
Right, exactly. And this is what, by the way, ironically, this is what we tried to do in Eastern Europe to a large extent after the Berlin Wall fell. That we all said, most of us, a few smart people didn't, but most of us said, this is easy. We just need to give them markets. Without realizing that, quote, creating markets as opposed to letting them sort of stumble forward, as we talked about recently with Mike Munger in the prisoner work camp, markets do emerge, but trying to create them explicitly and the institutions that support them is a cake that we don't have the recipe to, and it's a cake that needs to be baked in a certain order with a certain set of. We know the ingredients. We know it goes into the cake. We know it has to do with the rule of law, and we know it has to do with honest courts, and we know it has to do with contracts, and we know it has to do with freedom to enter and exit into those contracts. But how you get from nothing to something is quite a bit harder, as we found out in many in the developing world as well. So one level of ignorance is how to create those institutions.
And just to build on that, again, where did this failure occur? It occurred in this industrial policy sector where we had the most concentrated power of, where Washington did more to direct mortgage indebtedness and home ownership than in most other sectors of the economy. So we, in some sense, we've tried central architecture, and it was the central architecture that ultimately collapsed. And that you'd think that would be humbling.
Yeah, well, that's why I think the biggest challenge, and I've written about this, I know you have too, is to, instead of trying to figure out how do we recreate what we had before, how do we recreate something that doesn't have some of the systemic problems of what we had before. The idea that we would allow housing markets to be undirected without a champion via the mortgage deductibility of mortgage interest, enormous quasi-public, quasi-private entity like Fannie and Freddie to create the secondary mortgage market, to recognize that those were part of the problem and say, maybe that's not a good idea. That's a level we haven't gotten to yet, and I think it would be nice if we could get there. But the second level of knowledge I want to ask about, so I agree with all you said, but the second thing I think is important is that one of the levels of dispersed knowledge is that there are assets that are undervalued and there are assets that are overvalued. And some of those, and there are financial institutions that need to go broke, and there are others that need to grow because they didn't make these mistakes, and they should be scooping up these undervalued assets and ineffective firms. And it seems to me that unless that happens, whatever emerges in the aftermath of this is going to really be crippling to our capital market.
And what we're going to have in the short run instead.
And there isn't a good knowledge. No central planner, no Paulson, no Bernanke knows exactly what's on that list.
Absolutely. But in the short run, they are such big players and such aggressive players that everyone else has to go on the sidelines. I mean, how can you buy stock in an American firm now knowing that Paulson and Bernanke could shake it down at any point? The rules of our financial system have been completely thrown out the window. It's a rule of men, not rule of law situation in our financial markets now, and so everyone has to be on pause. I think if you've got money to invest, do you know how to deploy your personal investment at this point? Do you have any idea?
I did rebalance my portfolio a couple of weeks ago after one of the plunges, but I'm taking, I think, the attitude that most people are taking, which is sit back and wait. Don't know what to do. What's better than what you're doing now? Right. No one has any idea what would be. There's no obvious choice.
Right, and I think that the sit back and wait is exactly what banks. Paulson has the nerve, and Senator Schumer has the nerve to say, "Gosh, we're injected all this capital in banks, and you're not lending." Well, what are they supposed to do? How are they supposed to know where to turn when the government is going to be making up the rules? It's
hard. The president's coming into office. Could totally change everything.
How do you make long-term decisions, long-term commitments in that kind of environment? So, that's a very pessimistic note to sound, but that's the way I see it.
My guest today has been Arnold Kling of EconLog. Arnold, thanks for being part of EconTalk.
Thanks, Russ.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.